Welcome to this analysis by Corporate Lab. So, have we just witnessed the absolute peak of Wall Street banking power, or is this simply the new baseline for one of the most dominant financial institutions out there? Today, we are unpacking Goldman Sachs' frankly astonishing, record-breaking second quarter results for 2026. The numbers that just hit the wire absolutely shocked the market, and we're going to break down exactly how they did it, where the cash actually came from, and what the other side of the trade looks like.
As you'll see throughout this explainer, we're looking strictly at the hard data, basing everything entirely on SEC filings, earnings reports, and the facts right in front of us without any outside noise.
Okay, let's dive into this. Here is our roadmap for today. 1. Headline results. 2. Major segment drivers. 3. Market reaction. 4. The bear case. And 5. Looking ahead.
Section 1. Headline results.
All right, just look at this number. $20.98. That is Goldman's diluted earnings per share for Q2. Now, to put that massive figure into perspective for you, Wall Street's consensus estimate was sitting way down at $14.46. So they didn't just beat the street, they completely crushed it. And if we look back at the exact same quarter last year, Q2 of 2025, their EPS was just $10.91, meaning they practically doubled their per-share profitability in a single year. Wild, right?
And that bottom line was fueled by some absolutely massive performance metrics across the board. Net revenues soared to $20.34 billion. That's a huge 39% jump year over year. Net earnings landed at $6.63 billion. But honestly, the real showstopper here, that 23.5% annualized return on equity. Generating a 23.5% ROE at this sheer scale is a testament to incredibly strong operational leverage. The firm's book value per share also climbed up to $367.67.
Section 2. Major segment drivers.
Now, what's really interesting about this breakdown is how heavily skewed the revenue is toward one absolute powerhouse. We're looking at the complete dominance of the global banking and market segment, bringing in an astronomical $15.52 billion. Asset and wealth management delivered a very solid $4.6 billion, which is up 20% year over year itself. And then you've got this tiny sliver for platform solutions at just $221 million. So you can clearly see Goldman leaning right back into its historical core strengths. Zooming in on that massive global banking and market slice, we're seeing a 53% overall segment jump compared to last year. And breaking that down, equities, intermediation, and financing brought in an incredible $7.42 billion. FICC, that's fixed income, currency, and commodities, delivered $4.59 billion, and investment banking fees, $3.4 billion. The firm is just capitalizing massively on advisory, debt underwriting, and a booming equity market environment.
But keeping things completely objective here, it wasn't a flawless victory across every single desk. While global banking and markets saw that triumphant 53% surge, platform solutions took a massive hit, dropping 64% year over year. According to the filings, this drop is mostly from net markdowns on the Apple Card loan portfolio, which they actually transferred to held for sale back in Q4 of 2025. It's a stark contrast, isn't it? A blowout legacy banking quarter versus a heavy drag from their consumer tech experiments.
Section 3. Market reaction.
So how did Wall Street digest all this? I absolutely love this quote from the analyst firm Strategic Alpha. They noted the market's reaction was one of high-conviction bullishness. But the context is what makes this so fascinating. This outperformance happened exactly when the broader market was feeling quote-unquote heavy, with investors actively de-risking and pulling out of tech and semiconductor stocks. Basically, money flocked right to the proven, robust cash flows of a traditional capital markets powerhouse. And you can really see how this positioned Goldman against the competition. JP Morgan, Bank of America, and Wells Fargo all reported their earnings around the same time on July 14th. As you can see, Goldman emerged as a top-tier outperformer on a 52-week return basis when benchmarked directly against those primary banking rivals. It really highlights how perfectly their pivot back to core banking landed with the market.
Section 4. The bear case.
But as any good analyst knows, we've got to look at the whole board. This brings us to the ultimate intellectual tension of this explainer. Was this a fundamentally strong quarter that sets a brand new baseline? Or are we looking at peak earnings, literally the absolute top of a cyclical wave that's about to crash back down? And this brilliantly illustrates exactly what the bears are worried about. First off, investment banking and trading are notoriously cyclical. If market volatility drops, that equities revenue could normalize fast. Plus, you've got broader macro headwinds, like the Bureau of Labor Statistics CPI inflation metrics. If inflation stays stubborn, it could easily stifle the deal pipeline.
bears are also keeping a very close eye on the final resolution of that Apple Card portfolio to ensure we don't see any more bottom-line dragging markdowns.
Another metric that's always scrutinized is the provision for credit losses. Now, to be fair, Goldman saw a huge drop here, down from $315 million in Q1 to just $102 million in Q2. And while that decrease is undeniably great for current earnings, analysts are objectively watching consumer credit quality like a hawk. Any signs of deterioration down the line could signal some broader economic trouble.
Section 5. Looking ahead.
So the crucial point as we look forward is this absolute behemoth of a number right here, $4.04 trillion. That's Goldman's total assets under supervision right now. Why does that matter so much? Because while trading and investment banking fees are highly cyclical and jump all over the place, managing over $4 trillion provides a remarkably stable recurring foundation of management fees. It acts as a massive anchor for the firm's future.
As we roll into Q3, here's what we need to watch objectively. First, deal pipeline continuity. Can they keep up the underwriting pace? Second, trading environment stability. Third, we'll be looking for their capital return strategies, like stock buybacks or dividends. And critically, expense discipline. Management noted operating expenses were running 14% higher year-over-year, mostly driven by compensation and transaction costs. If revenue slows down, they are going to have to manage those expenses aggressively to protect that beautiful 23.5% ROE.
Thank you so much for joining this Corporate Lab analysis. Please remember, this explainer represents independent research and analysis for informational and educational purposes only and should not be considered investment advice. I do not recommend buying, selling, or holding any specific stock. So we leave you with this. Is Wall Street's golden child truly bulletproof right now, or is a cyclical reckoning inevitable? Keep learning, stay curious, and we'll catch you in the next explainer.